If you've heard anything that you are finding fascinating, please do use our hashtag IGFUK and follow us on Twitter, IGF Updates. So our next session is on the global investment climate, asking the question, have the COVID-19 clouds finally dispersed? We know it was a violent storm that had affected the entire global investment climate. Some estimates suggest that $9 trillion in global fiscal support was required to stop economies from imploding through the crisis. So now that the pandemic is almost behind us, at least in some parts of the world, has the investment climate improved? So with me to discuss this, I've got three fantastic guests for you. Here with me in the studio here is Anshu Jain, President Cantor Fitzgerald. Thanks very much for coming. And also I've got a couple of virtual guests for you. We've got Sanjay Nayar, Chairman of KKR in India. Sanjay, are you there?
Hi, I'm there. Can you hear me?
Yes, loud and clear. And we've also got for you Ashu Khullar, who's the CEO of CitiBank India. Ashu, are you there? I think we don't have Ashu yet, but we will get to him presently. Sanjay, let's start with you. Tell me, first of all, about the investment climate that you see. Has it improved, and are we back to the levels pre-COVID-19?
Question for me?
I mean,
that was for Sanjay.
Depends which investments you're looking at. If you look at just the capital market flows, they're all-time high, Eddie. It's unbelievable what India is attracting in terms of capital flows. But just getting away from that, I mean, if you look at it, what's going on here, 100 crore doses of vaccination was achieved today. So it's really a historic moment that, we've got 1 billion doses delivered, 20% double vaccinated, 50% single vaccinated. So from that perspective, I think the base is becoming very strong, and I think we are poised for hopefully a consumption uptick, which should follow when you have the economy opening up. So I think that's number one. Obviously, the markets are rewarding us way ahead of that, and that's fine. So the benefit of the doubt now, frankly, is on us to deliver. And if you just look at the kind of recovery we are having in all aspects, it's probably a result of a bunch of ongoing reforms for a long time, whether it's taxation, whether it's just the overall climate of corporate governance, the bank cleanup, continuing emphasis on the All India GST, which is kind of All India VAT, and some great recent announcements on retro tax, asset monetization plans. So you put all this together, I think the markets are looking through and really rewarding us for that. So I would say, Eddie, to your question, the climate is back. Flows coming from overseas are huge, also from Indian capital markets and mutual funds. And maybe later on we'll discuss as to what do we need to do to make sure that this thing sustains and actually delivers to the promise. But I would say we're off to a very good start. Vaccinations have been fantastic, and the government has remained a fiscal hawk through all of this compared to all other countries, which I think is commendable. I mean, you could really blow up the balance sheet of the country in these times and have an excuse for it. But this government has made sure they remain a fiscal hawk, delivered money where it's actually required in the small and medium enterprises, rural sector, and infrastructure, and yet made sure that I think one of the smaller with fiscal stimulus compared to anywhere in the world. So look, I think it's a good setting. Let's see where we go. I'm a well-wisher, obviously.
Anshu, let's come to you. What do you think about the investment climate? Has it returned?
Siri, first of all, it's a pleasure to be back in person.
In real life, right?
So this is the first one which I'm doing.
Welcome.
In a couple of years in person. We've all done our fair share of Zoom calls. So if that's a leading indicator for a return to normalcy, it's a very welcome one. Look, let's take cognizance of one thing. Before we talk about the fundamentals and how solid those might be, in 3 decades of watching markets, I've never seen a confluence of fiscal and monetary stimulus simultaneously synchronized across so many major economies in my life. And I don't think we'll see it again. And let's not forget, this began with the 2008 financial crisis. We never really withdrew that monetary easing which took place. And then we've added to that very significantly over the last couple of years. And for the first time ever, you've got the fiscal spigots on. Sanjay talked about how there's been rectitude in India. I don't think that's been accompanied in the US, UK, and most parts of Europe. Governments have really put stimulus and support ahead of every other priority, and well, they perhaps should have. And as a result, interest rates are zero, near zero, or negative, depending on the country you're looking at. And equity indices are making all-time highs. So I think there is a little bit of a disconnect. And in a minute, I'm sure we'll talk about specific sectors and where we see value. But if you ask me a general question, I think the level of risk aversion is the lowest we've seen in a long period of time. There's good reasons why we have low risk aversion, but there are going to be the inevitable consequences of it.
Tell me more about that. Why do you think that is?
Look, we are stoking inflationary pressures. There's no doubt in my mind, gravity always works. In the end, wages will go up. There are labor shortages now starting to crop up all over the world, especially the developed world. If you add to that, then here locally in the UK, Brexit pressures and so on and so forth, it's an inevitability that at some point the focus will go from supporting economies to fighting inflation. No one knows when that transition will come, but when it does, I think it'll be a rocky time for markets.
I'm not sure if we have Sanjay or if he's there. Sanjay, I wonder if you could speak to that issue around risk aversion. What are you seeing from India?
You know, I think the risk aversion from the foreign capital flowing in is frankly zero. To Anshu's point, I think flows are just coming into markets either as alternate or as the destination to be. I would say the bigger flows that we are focused on, or I'm looking at to really assess what is the real structural change, is the local private capital flows into capex formation. Those are still low, frankly, Eddie. Ultimately, you do need two hands to clap. You've got the foreign money coming in. I think you need a lot of local money to come in as well. Government is spending a lot of money in India. You need the private sector to spend. It's coming, but it's not there with the same spigots opened the way the foreign capital and government capital is coming in. So I think there is a bit of a balancing act, but I think we need to see the private sector come in with a lot more capex flows, and I think that's when the real action starts. So depends which flows you're referring to. I keep coming back to the fact of stock market flows versus capex flows. And I think investment cycle needs to pick up on the private side, not the government side. Government is already doing what they can.
Thank you. Ashu Khullar, CEO of CitiBank India. Thanks for being with us here today. Tell me, from your perspective, what you've heard so far, how do you see it in terms of the return of investment versus pre-COVID levels, and what's your view of the level of risk aversion that you're seeing?
Yeah, Edie, and apologies, I had some technical problems, so I missed some of what Anshu and Sanjay said, so I hope it's not disjointed. But I think things frankly look pretty good right now. And I think maybe it's the low point which we hit after the second wave in India, which, as you know, was pretty brutal, which, by the way, though, affected the economy less than the health, which obviously was fairly tough. But right now, on the ground in India, the sentiment is actually quite buoyant. And I know people have, Sanjay and Anshu were probably talking about the themes, but, we track a set of 33 broad economic indicators. And right now, we have just gone past the levels we had in February 20, which you remember was just before, COVID broke out. So almost 70%
what are some
of
those
the
indicators you're tracking?
Yeah, so I think if you look at Google mobility, railway freights, tax collections, uh, the only ones which are still behind are in some of the contact sectors like airline traffic, which, by the way, last weekend in India was the record flow of people flying again, but obviously lower than what we had before COVID. I think auto again, but that's more supply side. Actually, you can't get a car, frankly, anywhere in the world right now because of the chip shortage. But generally, the mood is very positive. I think our clients, and I know Sanjay was talking about private sector investment, which, yes, is an issue right now. But I think it started to flow. I mean, you've seen the kind of investment announcements from some of the bigger players, Reliance, Tata's, Adani, and my expectation is latter part of 22, early part of 23, we will start seeing the capex pick up as well. And I think the other point to note, I guess, is manufacturing, which is the classic capex which we track, is only 20% of the total investment in India. 40% is real estate, construction, and related sectors as well, which the sentiment in real estate again is picking up. So on the whole, ED I think feels pretty good. Obviously mindful of the risk of a third wave coming through, but a lot of things are coming together well for India right now.
So let's come back to you, Anshu, and focus on where you are most focused on now. What's the big priority for you now, and where do you see the challenges?
Is that specific to India now?
Yes.
Okay. So it's a big, vast country with lots of different sectors. Ashu has made some very interesting points. I agree with the bulk of what Sanjay is saying in terms of a broad economic recovery being on the cards. We are very focused on the high growth, tech-oriented companies in India. And there's a variety of reasons why I would say now is that time. India is a little late, but it's catching up and catching up very quickly. The UPI interface, the Aadhaar card, suddenly there's an accessible market of circa 200 to 400 million people that were untouchable from an e-commerce standpoint as recently as 5 years ago. So you've got 2 or 3 revolutions happening at the same time. Universal ID, biometric identification, leapfrogs India, pretty much the top decile of the world, from having no identity to having a verifiable PAN tax account and a biometric identification is huge. Secondly, you've had a mobile phone revolution where I think there's 7 times as many mobile phones, and think of that really as internet connectivity across the board. It may not be 4G, 5G, it doesn't need to be, but these are smartphones. So suddenly insurance, food, basic banking services are being provided to individuals for the first time. There's a very exciting social consequence of all of that, which is great. But to me, there's a hard-nosed business upside from that, which we are very focused on. Investors, of course, are not oblivious to that. There's been a series of local listings. You've had companies like Zomato suddenly go public. Paytm's about to go public. Policy Bazaar is on its way towards going public. So these are all very interesting opportunities. We are focused on trying to identify the next generation of those companies and really trying to build a bridge between Western capital and Indian opportunities, specifically in that sector. And that can be done through a variety of instruments, and we're looking at all of them. So my caution regarding broad risk aversion and stock indices notwithstanding, this is real, and I see this as a multi-decade opportunity.
So let's come back to our virtual guests and get you to reflect on that. From what you've just heard there, Sanjay, are you also focused on the high-tech sector, or is there anything else you're putting your mind towards these days?
No, I mean, look, obviously, as Anshu says, you have to focus on the high-tech sector, and obviously we are all focused on that. But I would say there's a lot of capital that is waiting to come into India, even in the most boring but very sustainable area of infrastructure, frankly.
Like what?
And I mean, there's just a big national asset monetization plan just announced by the government. You've seen some private sector folks do that. And I think India needs to raise a massive amount of revenues by not doing an outright sale, but a sale and lease back of some of the assets like transmission grids, oil and gas pipelines, roads. And you cannot ignore that, because structurally, the balance sheet of the country needs really long-term capital to correct the balance sheet. I mean, we do have a very large fiscal deficit. So while we can focus on, the underpenetrated markets, and I agree with Anshu, there's a huge amount that's going on in terms of driving consumption through e-commerce. But the fact is, the structural part of the balance sheet needs to be corrected, and this government is extremely focused on that. Besides being a fiscal hawk, they're also trying to raise revenues to correct the fiscal imbalance. And I would say that for foreign capital, infra capital coming into India in a well structured, well presented asset monetization plan can bring in tens of billions of dollars. So I think that's where I would sort of put my energy if I was a kind of guy doing a betting game. And the other thing I would add is that you also need local capital. I mean, it's just not foreign capital. You have to unlock local savings pools. So local insurance and pension reforms. Again, this government is doing it, tinkering a little bit, because obviously they have a big fiscal to take care of. But slowly and slowly, the local savings are coming into the market. You see our capital markets. You see the size of our mutual funds. You see the invention of REITs and InvITs. I mean, you're seeing new instruments, new pools of capital coming in. You need that alongside the foreign capital. So I would say I would really focus on also making sure that the foreign capital and local capital to correct the fiscal situation will lead to a much better structural change, which will lead to a much better sustainable structural GDP in the future. So not taking away anything that Anshu said, I think in terms of what's going on in the growth tech area, I think we have to focus on the big sort of the big gorilla out there, which we all sort of ignore, including I do. But I think when you put your thinking caps on, you have to get the balance sheet corrected, and there's no better moment for India than today when infra money, you know, is just happy to flow into India. And the kind of governance that India is delivering now, the kind of institutional reforms, and the kind of asset monetization plan they've announced, I think India could attract a lot of capital for that.
It's interesting about what India needs to do there for sustainable growth and recovery. Ashu, from a CitiBank perspective, would you say the same thing in terms of looking at getting the balance sheet under order?
Yeah, so Edie, we obviously, as a bank, follow our clients, and I think Anshu and Sanjay has obviously talked about the institutional opportunity, which is great, and we are very active in the capital markets as well. And I think it's a record year for IPOs, record year for M&A, and I think the pipelines look very robust. But I think I want to talk about the other side of foreign capital, which is about foreign direct investment. And I think, with the geopolitics, the way it's playing out with China, and especially the focus of a number of global companies around China plus one diversification of the supply chains, I'd say that India perhaps was a late starter, but I think the government has actually, focused the production-linked schemes, incentive schemes, which the government of India has launched, which could have a fairly material impact. One, from a local employment perspective, they're going to give incentives of almost $25 billion, which would generate around 30 million jobs across 8 sectors, and of which electronic manufacturing has already been the first one, off the track and got very good momentum. So I think we are, as we talk to a number of our, foreign clients, including Indian clients, that is an area of focus, which is great because, India needs more manufacturing and India needs more jobs. And I think this is a good way to get that. So as a global bank, certainly, we frankly feel the secular trends of India right now play exactly to the strength of a player like us, right, in terms of intermediating foreign flows into India, whether it comes through the institutional way or a corporate FDI route.
And can I get you to think about what a potential free trade agreement or even loosening of some of the tariffs and boundaries around trade might do for even more investment and trade flows? Ashu.
Yeah, so I know the foreign the FTA between India and UK is about to kick off, and it's a highly complex subject. So it's hard for me to get into specifics, but I know there is a lot of opportunity and upside to the UK and India relationship, right? I mean, there is a history. I think there is a cultural comfort. And I think there have been certain sectors which consumer healthcare insurance, where UK has classically been a big investor in India, engineering. But I think there is a lot more potential around fintech, I'll say infrastructure. And I think from what I understand, the key areas of discussion are going to be the old chestnuts, around data, around access to markets, some discussions, I believe, around insurance, reinsurance markets. But, I think there's a lot of opportunity, for post-Brexit UK looking for, doubling down, and in India where I think the moment has truly come.
Anshu, should we talk a little bit about some of the instruments that you're using to help investors get into India specifically?
Happy to, but before we do that, let me just pick up on the UK specific question that you asked, Ashu. I'll add my perspective to it. And that, frankly, would be that the US is right now dominating it completely. It's not even close. Sanjay made a good point, and by the way, it was not my intention to say that tech is the only opportunity. This is a subcontinent with 1.3 billion people. That's what makes it exciting, and there's a slew and a whole spectrum of opportunities. Infrastructure investment will give you stable but relatively predictable lower yields. Equity will give you very high double-digit returns, hopefully, and then you've got opportunities in the middle. In my mind, the US is utterly dominating from a variety of ways, and that'll lead me to answering your question specifically.
Utterly dominating in terms of?
Every which way. So first and foremost, if I think about, and Sanjay happens to represent one of the largest, if you go to Mumbai and you ask yourself, who are the people that are making large hard capital inflow investments into India? Who's actually local? Vast majority. It's the same names that you will see on the Upper East Side in New York, now colonizing Mumbai. If you look at listings, it's either domestic listings, which suddenly are very much in vogue, but if it's not, it's a NASDAQ, which everyone's looking at. So I would say London right now, I'm not sure how the UK would self-assess where it stands. Ashu makes a point that in insurance and certain aspects of fintech, certain aspects of manufacturing, the UK has got niche strengths which is connecting. But generically, if you ask me about flow of capital, it is almost exclusively a US story. UK is lagging. Continent, by the way, doesn't understand India at all. I think about German, French capital, continental capital. They've been involved with and they understand China far better than they do India. So really, this is a US-India partnership. It starts with the geopolitics, but really, in the end, it's pure simple laws of finance. To answer your question, which instruments? It's a variety of instruments. You're talking about a sector which is severely undercapitalized. I'm still now back to tech.
Okay.
And really fast growth companies. I include within that fintech. I include within that non-bank finance companies. So sort of your challenger models to traditional bricks and mortar. These are companies which are very exciting, but they need to be funded and they need to be equity funded. So look, I mean, it's domestic listings, it's private rounds of capital. Sanjay makes a good point, which is domestic capital needs to be accessed. But right now, from what I can see, domestic capital is just not there in the magnitude, speed, or flexibility. That'll change, hopefully. But as things stand today, it really still is international capital which is bankrolling most of these companies. And there are the strategic advantages of getting acquisition currency when you list in the NASDAQ. So if you want to be a global company, being NASDAQ listed just gives you a currency and a credibility, which is very significant. And then, of course, SPACs are a very interesting alternative as well.
And just say what a SPAC is.
A special purpose acquisition company, where you basically merge with an already listed blank check company and you access public markets instantly. But it's really a subset of going public.
Thank you. Sanjay, I wonder if you want to say a little bit more about unlocking domestic capital and what, in fact, do you think could do that?
I think, look, I mean, unlocking domestic capital is very critical. Luckily, we have regulators and an infrastructure that is quite ready for that. So both on the debt side and the equity side, we have very good infrastructure in terms of the market, trading systems, settlement systems, access to retail markets. I think the big issue is reforms and regulators within the country coming together under the leadership, obviously, of finance to try to see what are the tweaks we need to make to different thresholds and risk parameters that these companies have to follow, especially the public sector and the private pension funds and insurance companies, to be able to get long duration capital into the real market, so both equities and debt. Now, there have been a lot of changes, by the way, in the last 2-3 years. This government has done a lot of tweaking and a lot of changes to encourage that flow to come in. But it's very critical that you have the capacity to be able to invest and the right kind of management in these pension and insurance companies to be able to make the right investment decisions. So there is a capacity creation issue. And the second thing is that you need the right kind of issuers coming in and raising debt and equity, where I think the regulators do a pretty good job of sifting and filtering and making sure that the right kind of companies are coming to the market. And again, you come back to the recent innovations of alternate investment funds, IDFs, InvITs, and REITs. These are pretty unique, and they're just coming of age. And for them to come of age, you also need supply of capital. And dare I say, you need more local capital in these than foreign capital. So I think this will get timed, and it'll get kind of catalyzed as the government gets focused on bringing its own fiscal under control, which I think will take a little longer thanks to COVID. And I already said they've been extremely conservative on the fiscal, which is good. It'll take some time. And then that's when the spigots get opened up. I mean, your longest duration savings, Eddie, are always in local insurance and pension. Okay, and all of us bring imported pension and insurance. There's local pension insurance. So I think small tweaks are probably on their way. I would say if India has to be self-reliant, you do need self-reliant capital. You can't be self-reliant entirely unless you have self-reliant capital. So I think those are some very important steps that will happen. There are minor reforms. I don't think we need to go into the detail. Okay. The government, I think, knows about them. They're quite focused on it. And I think, well, I just hope they'll do it at the right time and pretty soon.
Thank you, Sanjay, and thank you to all of you for spending some time with us talking about the global investment outlook. Been delighted to be speaking here with Sanjay Nayar from KKR India, Anshu Jain, Cantor, Fitzgerald, thank you for coming, Ashu Khullar, CEO of CitiBank India, and we will be right back.